In the first video, we covered interest rates and inflation, both where they are today and where they've been historically. The second video, we covered our outlook for the bond market. In this video, I quickly want to cover the slides going over our equity market outlook. Now, importantly, we're not trying to time the stock market to tell you when to get in and when to get out. Ultimately, we are long-term equity market investors. The purpose of these slides is just to put today's market in historical context and show why we're still very, very optimistic about the market and why we think that it still has a lot of room to run. So first, money market assets reach historic peaks. So at different times in history, money has fled the stock market and gone into the money market because essentially people are scared of the stock market and they'll do anything they can to get out of it. Right now, with interest rates on the short end having gone up, money markets paying upwards of 5%, we've seen massive flows into money market funds. Historically, when that's happened, the equity markets have actually outperformed. Human nature is a failed investor. People tend to get in at the wrong times and out at the wrong times. So when we see money fleeing to money market, that actually gives us confidence that the equity markets are poised to do better. So what we've seen is that in the last three pullbacks, or I should say the last three times when money has fled to money markets, equities have generated 16, 19, and 12% respectively over those last three peaks. Whereas historically, since 1926, the stock market has generated 10.2%. So again, this is just one item that gives us some confidence that the equity markets are poised for continued growth. This slide here has a lot of numbers on it, but the top is really the most important, where it shows the anatomy of bull markets going back to 1950. We've had 12 different bull markets, and in order to have a bull market, we've had a rebound out of bear markets. And a bear market is when the market goes down in excess of 20%. So since 1950, the stock market has gone down over 20% almost once every 5 years. And some of these have been massive declines. 74, we're down 48%. If we go to 2002, the market was down 49%. 09, we were down 56%. Tremendous declines. And yet, the stock market continued to have an average return of 11.4%. So with the stock market, it's important to stay invested because the rebounds tend to mirror the declines, and you don't know when those declines are going to be. But where is our growth going to come from? A lot of people look at the stock market and they just see tickers and numbers and charts, and they don't recognize that an investment in the S&P 500 is an investment in the 500 largest, best capitalized, most sophisticated, best well-run companies in the country and throughout the world. And so what we're looking at here is that AI has been the theme of this year. When ChatGPT came out, it inspired a ton of different conversations, and the S&P returns this year have been driven by 7 names, mostly focused on the AI sector. NVIDIA, Apple, Microsoft, Tesla, etc. And so what we've seen is that the amount of innovation that's taking place has happened very, very rapidly. So it took 70 months for Uber to hit 100 million users, Spotify 55, Instagram 30, TikTok 9 months. Now ChatGPT has 100 million users in 2 months. So what we're seeing is that the speed of innovation continues to climb. And what is AI going to change? Marketing. By 2025, 30% of outbound marketing messages will be artificially generated. Of course, not the emails I sent, but everybody else's. Healthcare. AI-trained healthcare models review and translate mammograms 30 times faster than traditional methods. Education. $1.2 trillion is the U.S. education market alone, and that is at risk of being disrupted. And customer care. Obviously, you have third-party call centers and service centers can be disrupted tremendously by AI breakthroughs. Now, why is that important? It's important because stock market growth comes from innovation. And it's not just random bubbles and charts and people just think of, oh, the stock market went up, it's getting ready to collapse. But from 1972 to 2022, the S&P 500, again here excluding dividends, went up 32 times. And the reason is because earnings went up 35 times. And so it's not just that the stock market went higher, it's that earnings. What you own when you own a stock, you own a company. And the company's earnings went up by 35 times, so the stock market went up 32 times. Intuitively, that makes sense. Earnings went up, therefore the price of these companies went up. But why did earnings go up? And that's where I point out here, the productivity of an American worker skyrocketed. Adjusted for inflation, real GDP per capita rose from $26,000 to $60,000. Now, that's important because we're talking about real numbers. So above and beyond inflation, the average per capita GDP, meaning how much GDP is being put in the market by a single worker, has gone skyrocketing. And advances like AI are just going to continue helping that number compound, which is going to further compound earnings, which is going to further compound long-term growth of the equity markets. And here, of the 10 largest companies by index weight in the S&P 500 today, 9 did not yet exist at the end of 1972. So when we start looking back over the last 50 years, it's important to remember that the companies that were the biggest back then, some don't exist today. Some are shrunk down, and they've been surpassed by companies that are in fields that couldn't even be imagined back then. So when you start looking for where is the earnings and growth going to come from going forward, it is very likely that the biggest companies 50 years from now do not exist today, and they're going to be operating in fields that we can't even comprehend. So that is what gives us our long-term optimism at the markets, and we think that we're in a great place today and that the growth is going to continue despite what you may read about and hear about on TV. So that's it for this video. And in the next video, we're just going to talk about the psychology of staying invested. If you have questions about this or anything else, let us know. Otherwise, the last video is coming up.